if you've never made an investment before, it could be quite intimidating, right? You think you have to have lots of money, you need to know the stock market inside out. It's actually a lot simpler than that, in particular if you're a beginner. And the reason for that being is you shouldn't pick stocks, you should actually go with a proven track record fund or ETF and a platform that doesn't charge you any fees. Now, there are a couple out there that I use. I use Trading 212 and I use InvestEngine, and they have all of the funds that I need. And one of the most popular funds out there is the S&P 500, which is a collection of 500 companies in the US, and so a lot of tech stocks in there. So think about Microsoft, Amazon, Netflix. They're in that group, and they do particularly well, but past performance is not an indication of future growth. On top of that, there's also all world indexes. So they are made up of, say, 60-70% of the US, and then they cover the rest of the world as well. And that gives you a little bit more of a hedge against anything going particularly bad in the United States. To get started, all you need is to install an app or sign up online to one of the two platforms I mentioned. There is a link in my bio for both. You can get free shares and bonuses and stuff by signing up via them. And you deposit some money. You pick a fund. So I invest in the VWRP, which is Vanguard's version of the All World Index. I also invest in a bunch of other stuff, but that is a fairly beginner friendly investment fund. And then you just set the amount that you can invest on a monthly basis. Let it do its thing, okay? Now, when you're getting started, make sure you only invest in money that you don't need. And by don't need, I mean don't need immediately, okay? So your emergency fund shouldn't be invested because the markets go up as well as down, and you don't want to have to pull your money out if it's running at a loss temporarily. So you want to invest money for the long term. Ideally, general guidance is for 5 years plus, but the longer the better. Compounding does its thing over time, so the longer you leave it in there. Think long time horizons like 10, 20, 30 years. It feels a long time away, but before you know it, like I turn 40 next month, and I really wish I had content like this available to me when I was 20. And I had 20 years in the market versus actually starting investing just last year. Once you've done that, you've set it up, kind of auto investing on a monthly basis, whether it's 25, 50, 100, 200 pounds, whatever you can afford to not worry about for many, many years. Just set it and forget it. Check it a couple of times a year if you wish, but don't panic when things go bad. Don't get too excited when things go good. The market will go up and down over the years, and it doesn't really matter, because when you zoom out over that longer period of time, what you're hoping to see is a graph that goes up. If you zoom in too much, what you're going to see is a graph that goes like that. And that is what panics new investors. Hold the course, pick a fund, invest in it, and just leave it alone for a long period of time. And you will, 99 times out of 100, end up in a much better place than you would by saving instead.